Right. Inventory of an entity consisted of two items A and B. The following information is provided with regard to the inventory balances as at 31st of March 2011. So they have given us the we have two types of inventory: physical balance and book balance, unit cost, expected selling price, and expected selling expense. So they have asked us to compute the inventory value to be shown in the balance sheet if the inventory is valued on item by item basis. So we have to compare each item's cost and NRV. Write the journal entry to adjust the inventory difference, assuming that the value of the difference between the book balance and the physical balance of inventory item B is recovered from the storekeeper at the expected selling price. Okay, so let's see. So if we take a look at item A, the physical balance is 1000 and book balance is also 1000. Item B, physical balance is 800 and book balance is 900. Now what does this physical and book balance means? Now book balance is you are maintaining a record. When inventory comes in, you are recording it. When inventory goes out, you are recording it. Physical balance is okay. So your book balance is showing you have 900 units. So when you go to the store and you count the inventory, that inventory is only 800 units. Okay, so which means book is showing 900. You go to the store and you count, it's showing only 800. So 100 units of inventory is missing. Who is responsible for this? The storekeeper. So we tell the storekeeper, you're responsible, you have to pay this. So he will pay. Okay, so 100 units of inventory is missing and we will recover this from the storekeeper at the expected selling price. Just keep that in mind. Okay, so first things first, we will find the NRV. So expected selling price minus the expected selling expense, we get the NRV. So 75 minus 15, 60. 65 minus 5 is also 60. Okay, so cost is 40, NRV is 60. We will take the cost. For item B, cost is 70, NRV is 60. So we will select the NRV. So for inventory value to be shown in the balance sheet, so we have 1000 units of inventory for item A into 40. For item B, we have 800 units into 60. Okay, right. Now write the journal, so you will get the total, that is the answer. Write the journal entry to adjust the inventory difference, assuming that the value of the inventory difference between the book balance and the physical balance of inventory of item B is recovered from the storekeeper at the expected selling price. So 100 units of inventory at the cost of 70 is missing. You go to the store, you have 800 units, but your book is showing you should have 900 units. So 100 units is missing. The cost of this one unit is 70. So 100 into 70, your cost is 7,000 units. So 7,000 units of inventory is missing. So if inventory is missing, the inventory in your purchase account is decreasing. So your purchase account will get credited by 7,000. Give me 1 second. Okay, so now we are going to recover 100 units is missing, but from the storekeeper, for each unit we are going to recover it at the expected selling price 65. So for each unit we will get 65 from the storekeeper. So 100 into 65 is 6,500. So we will recover. So receivable, storekeeper receivable, it's receivable, so it gets debited 6,500. 7,000 worth of inventory is missing. We will recover 6,500, means our stock loss is 500. So this is the double entry for B. A company has provided the following information as of 31st of March for 3 items of the inventory. According to item by item basis, what is the value of the inventory as of 31st of March 2012? Okay, so item by item basis. So again, expected sales minus expected selling expenses, we will get the NRV. 15 minus 5 is 10, 16 minus 4 is 12, 19 minus 7 is 13. No, 12, sorry. Okay, so the cost and NRV. Cost is 13, NRV is 10, we select the NRV. Cost is 10, NRV is 12, so we select the cost. Cost is 17, NRV is 12, so we select the NRV. So 10 plus 10 plus 12 is 32. A is the answer. Amal Traders lost its entire inventory as of 31st of March due to a fire. The information available on that day is as follows. Okay, so opening inventory, purchase, sales, firm's gross profit margin on sales is 20%. So what is the value of inventory destroyed due to the fire? What is the net impact on total assets as at 31st of March 2012 if an insurance company agreed to indemnify 80% of the value of the inventory? Okay, so Amal Traders has lost its entire inventory as at 31st of March due to a fire. So let's draw sales minus cost of sales, we get the opening stock, purchase minus closing stock, we get the gross profit. Our sales is 2000, opening stock is 200, purchase is 1500. Gross profit margin is 20% on sales. So if our sales is 2000, 20% of this is going to be our gross profit margin. So 2000's 20% is going to be 400. So if gross profit is 400, our cost of sales is going to be 1600. So 200 plus 1500 is 1700. So 1700 minus your closing stock, your cost of sales is 1600. So take x to the other side, bring 1600 to this side. So your closing stock will be 100. So value of inventory destroyed due to the fire is 100,000. Don't forget to write the 3 zeros. What is the net impact on total assets of the company if an insurance company agreed to indemnify 80% of the value of the inventory? So 100,000 is 80%, which means 80,000 the insurance company will give us compensation. So we will get, I will first explain it from the double entry. So we will receive compensation from insurance company 80,000. So insurance compensation receivable is an asset. It gets debited 80,000. Now 100,000 worth of inventory is destroyed. Inventory in your purchase account is decreasing. So your purchase account will get credited by 100,000. Okay, 100,000 worth of inventory is destroyed. You're going to get only 80,000, which means your stock loss is 20,000. Now the question is not that net impact on total asset. Okay, right. Okay, your inventory is decreasing by 100,000 minus 100. Okay, you are receiving compensation receivable, you are receiving compensation of only 80,000. So net impact is a decrease of 20,000. Okay, the following information relates to a company for the month ending 31st of March 2013. The company uses FIFO method to price the inventory issues. NRV of year-end inventory is 120 per unit. What is the cost of sales for the month ending and inventory value as at 31st of March? Okay, so let's see. So on 1st, 7th, 15th, then after all these purchases only on 20th they have sold 8,000 worth. Okay, so first and foremost these 1,000 units has gone. So 1,000 units into 100, 100,000 worth of inventory is gone. Then 5,000 units. Okay, let me write both, then you all will understand. So 1000 units, and 1000 into 100 is 100,000, that is gone. It came in first. So second lot is 5000, it's gone. It came at 120. So 5000 into 120, I think it has to be 600. Let me just do the calculation just to be sure. 120 into 5, yes, it's 600,000. Okay, now as of now we have sold only 6000 units, so we have to sell 8000 units. So I have to sell another 2000, so that 2000 will go from this lot. So this 2000 will go at the cost of 140. So 140 into 2000, it is 280. Okay, so your cost of sales is 6, 7, 8 and 9, 980,000. I cross these out. Now this is gone, this is gone. 2000 from this 3000, 2000 is gone, which means only 1000 units is remaining. Okay, so we have only 1000 units of inventory. Okay, now the cost is 140, NRV is 120. LKAS 2 is telling us to select the lower of cost or NRV. So 120 is low, so 1000 into 120, it will be 120,000, which means C is the answer. Okay, the entire inventory of a company held at 31st of March was destroyed due to flood. The following information is provided for the year ending 31st of March 2013. It is a policy to sell goods keeping a markup of 20% on cost. So sales minus cost of sales, opening stock plus purchase minus purchase return minus closing stock, we get the gross profit. Okay, entire inventory was sold. So our opening inventory is 1500, purchases is 3500, purchase return is 500, then sales is 4800, selling expenses goes to your distribution expense. Okay, now markup is 20%. So markup is your gross profit as a percentage on your cost of sales. So if your cost of sales is 100, your gross profit will be 20. So which means our sales should be 120. So if 120% is equals to 4800, we can find how much is 20%. So 4800 into 20 divided by 120, our gross profit is going to be 800. So if our gross profit is 800, our cost of sales is going to be 4000. So when I do this calculation, that is 1500 plus 3500 minus 500, it is 4500. So 4500 minus your closing stock, your cost of sales is 4000. Take x to the other side, bring 4000 to this side, it will be 500. So your closing stock destroyed due to fire is 500,000. Okay, so the following information pertains to a product of a company for the month of March 2014. Okay, the company uses FIFO method to price the inventory issue, cost of sales and inventory, closing inventory. So we purchased, we had opening balance, we purchased, then we returned the goods purchased on 10th of March. Then purchase, sales, inventory. So we purchased 5000, we have returned the goods purchased on this lot, means the purchase return unit cost is 5000. So simply 5000 I purchased, I returned 1000, means we technically purchased only 4000 units. Okay, so let's see. So first and foremost, we have to find how many units did we sell. So my opening inventory was 3000. I purchased 5000, returned 1000, means I technically net purchase is only 4000. Then I have purchased another 3000 units. So total number of units I have purchased is 10,000 units. Okay, 4, 5, 6, 7, 8, 9, 10. Then I have sold an X number of units. and 4,000 units is remaining. So which means I have sold 6,000 units of inventory. Okay, first in first out method. What comes in first is going to go out first. So this 3,000 units at the rate of 80 is going to go. So 8, 16, 24, that will be 240. That is 3,000 units. So I have to sell another 3,000 units. So that 3,000 will go from this lot that was purchased at the rate of 90. So 9, 18, 27, 270. So 270 plus 240 is 510. We have one answer, but let's check if we are getting our closing stock as 300. Okay, so now out of this 3,000 is gone. Out of this 4,000, 3,000 went. So which means 1,000 units at the rate of 90 is there. Then the entire 3,000 units is there at the rate of 70. So 19 to 1,000 is 90,000, 17 to 3 is 7, 14, 21, 210. So 210 plus 90 is 300. Yes. Okay, so for this, it's a little bit, it's a less of inventory thing. It's more of, what do I say, the correction of errors. But yes, I will be explaining this because it's a past paper question and somewhat of a good question. Let me take another. I will explain that during the class hours because, where is it? Okay, so this question I will be explaining during the class, today's class. Let me do only the LKAS question, LKAS 2 question. The following information relates to an inventory item of a company for March 2015. The company uses FIFO method to price the inventory. Issue the NRV of inventory as of 31st of March was 70. Cost of the inventory and its carrying amount. So we had 1,000 units. I purchased 3,000 units means totally we had 4,000 units of inventory. Okay, I have sold 2,000 units means 2,000 units of inventory is remaining. First in first out method, what comes in first is going to go out first. So okay, what comes in first is going to go out first. So this unit of this is gone. Out of this 3,000, 1,000 units of inventory will be gone. So which means the 2,000 is remaining from this lot. So 2,000 at the cost of 80, it will be 160. Okay, so A is gone, B is gone, C is gone. Now cost per unit is 80, NRV is 70. I will select the NRV. So 70 into 2,000, your carrying amount of inventory is going to be 140. Okay, so carrying amount is talking about lower of cost or NRV. What is going to be shown? The entire inventory of a firm was destroyed on 31st of March due to a fire, and the following information has been provided. The firm sells goods with a markup of 20% on cost. The insurance company has agreed to pay 80% of the cost of inventory. What is the cost of inventory destroyed and the stock loss? Okay, so let's write sales minus cost of sales, opening stock, purchase minus closing stock, you get the gross profit. So my say in opening stock is 750, purchases is 1750, purchase return is 250, sales is 2500. You see, this is a 2019 past paper question, and the sales expense was tested somewhere, we just explained, was tested somewhere in 2013 or 14. And sales expense, it doesn't come, it goes to your distribution expense. Markup is 20%. So what it means by markup is, if you're out of your cost of sales, the percentage of gross profit. So if your cost of sales is 100, your gross profit is going to be 20. So which means your sales is going to be 100. Okay, sorry, sales is going to be 120. So if 120 is equals to 2400, I need to find how much is 20. We have to do the cross multiplication. So 2400 into 20 divided by 120, your gross profit is 400. So if your gross profit is 400, your cost of sales will be 2000. So when I do this calculation, that is 750 plus 1750, take away 250, this is 2250. So 2250 minus your closing stock, your cost of sales will be 2000. So you take x other side, bring 2000 this side, 2250 minus 2000, your closing stock is going to be 250. Okay, so C is gone, D is gone, E is gone. So insurance company has agreed to pay 80% of the cost of inventory. I will explain this as a double entry. So 250's 80% we will get from we will get insurance compensation. So 250's 80% is 200,000 we will get compensation. Now the stock of inventory destroyed is 250,000. So your inventory or your purchase account will get credited 250,000. You will receive compensation of 200,000. You will receive, so it's an asset, it's a receivable. 250,000 worth of inventory was destroyed. You will receive 200,000, means your stock loss is going to be 50. So stock loss of 50, A is the answer. Thank you.